Hey everybody, back with another video, and today we're going to be taking a look at the January CPI numbers that came out either today or yesterday, depending on when this video gets uploaded. We're just going to take a look at the numbers, what they mean in context of the economy, the market, what they mean in terms of rates, rate hike decisions coming up, and what they mean for you. So let's jump on into it. And remember, for this, we're going to assume that the numbers they're using are accurate, even though we can probably assume that inflation is higher than these numbers, but let's give them the benefit of the doubt for this particular analysis. So starting out with headline CPI, we are looking at 6.4%, which is a little bit above the consensus estimate that we had of 6.2% from market watchers, and down just slightly from 6.5% last month, that being December. So we can see that inflation really is not easing. A 0.1% drop for 1 month, not great. We had heard people saying, inflation is going to ease down in 2023, that, by the second half of this year, we're going to be back towards 2 to 3%. That doesn't look like it's happening this year. Inflation looks a lot stickier than, what we were told. First, it was transitory inflation, and then it was going to come down quickly. Doesn't seem to be. For our month-over-month, inflation was up 0.5% compared to the 1% in December, which was revised up from being less than 0. It was forecasted to be right at around 0.5%, so no big surprise there, and it was down from the quote-unquote peak last year when we were up over 1% month-over-month. So we can see that, again, not much is changing. Inflation is not decreasing by much, if any. We're still at where we were at the end of last year. When we look at core CPI, which is what some people prefer because it gets rid of food and energy, we can see that we're at 5.6% and 0.4% month over month. That was pretty much what people thought was going to happen, about maybe 0.1% off depending on who you ask, but that was really what the projections were. And again, we're seeing here that, again, not moderating very much. We aren't getting down back to that quote-unquote 2% target, or for core inflation, which is actually slightly below that, a little under 2% target anytime soon. This looks like it is going to continue. Now, what does this all mean for you? This means that you're going to see prices continue to increase, at the grocery store, at the used car lot, anywhere you're looking for things that are going to be affected by this a lot. You're still going to see eggs being ridiculously priced, stuff like that. Aside from that, the biggest news is going to be with rates. It's pretty much been decided, based on what we have, that the Fed is likely going to raise rates by 0.25 point at their next two meetings, which are in March and May. If for some reason CPI drops by 1.5% over the next month, 2 months, that might not happen. But most people making predictions are well aware that that is going to happen. We're very likely going to see 0.25 point increases there. And also for July, very likely, not as likely, because there is, of course, the time duration there, but it's likely that we're going to see at least 3 more 0.25 point increases over the next 6 months. So just be aware of that. On my personal side, I don't see them stopping raising rates before 6%. I still my prediction that I had, which is it's going to be somewhere between 8 to 10% at the end, is still what I think is going to happen. I don't think it's going to happen as quickly as I thought it was going to previously. I thought we would be over 5%, well over 5% by now, but that's wrong. We're still sticking at around 4.5% now. Probably won't hit 5% until the next meeting. But after that, once we get into the summer, we're going to see the Fed funds rate over 5%. That's almost a given at this point. It can't happen unless they want to see inflation shoot back up into, double digits. So for the most part, things are going to continue going as they are. They're going to keep getting worse before they get any better. We aren't going to see that 2% inflation target anytime in 2023. That's just not going to happen. The people who are saying this is going to happen in the second half of the year, don't listen to them. They really don't know what they're talking about. If we're lucky and the Fed gets its stuff together, maybe 18 months, if they go crazy and start raising rates by a full percentage point, I don't see that happening. I don't see that 2% target really getting anywhere near us till 2025 at the very earliest, possibly even later than that. So just keep that in mind. But, make your own predictions, look at the math the way you want. Don't just take my word for it. So what is that going to mean for you personally? The things that you're doing, the things you're invested in, so on and so forth. I really do see 2023 as being a flat year on the market. All these early gains I do see being erased over the summer. The whole sell in May and go away is probably going to happen this year. I do not see a huge market downturn this year just because the conditions aren't right for it. We need that catalyst. But, a year where the market's only up, 2 or 3%, or it's down very slightly or completely flat is really what I think is going to happen based on, the numbers we have here and what happened last year and what's likely going to happen, based on them. When it comes to you yourself, your savings accounts, you're very likely by either the summer or the fall of the year going to very easily be able to find savings accounts at around 4%. With the Fed funds rate moving up, the savings accounts are very much going to have to keep pace with that, the high yield ones. I'd expect to see in March, May, and July, it's almost guaranteed. With those, you're going to see at least 0.1% increase on your savings account. A lot of them might go higher than that. You might find some of those, deals where as long as you don't go over $10,000, you might be getting 6.5%. That wouldn't surprise me at all. When it comes to treasuries, this is where it's going to get really interesting. As we can see, currently treasuries are doing quite well if you're invested in them. If you're looking to invest in them, I should say. If you have them right now, you're a little annoyed. But if you're looking to, go for short-term treasuries, we have the 1-month bill at 4.5%. The 1-year bill is currently at around 5%. If you wait until, summer of the year, it's probably going to be it's not going to be hard to find treasury notes, 1 year, 2 year, maybe the 3 and the 6 month one, at around 5, somewhere between 5 and 6%, probably closer to 6% if these things keep going on. So if you're just doing short-term 1 month, 3 month bills and still rolling over, I think you're going to probably do very well. Those rollovers are going to be higher than they were previously. If you're looking at longer term things like 3 to 5 years, I would personally hold off on that because I think you're going to be able to do better if you can just, stay the course and hold that cash somewhere like a savings account or something like that. I think you're going to see higher rates on treasuries going into the second half of the year. It's going to be very hard for treasury rates to fall. Something amazing would have to happen for that to occur. In terms of some more investment type things, money market funds probably going to continue to see increases. Again, by the fall of the year, you're probably going to be able to find money market funds easily paying 5%, possibly in excess of that. So, if you don't want to keep stuff just in savings, or you want a bit more liquidity than treasuries, money market funds are probably going to be doing very well. When I was talking about my portfolio is likely going to increase that position, my money market wedge of my portfolio, that's going to continue to happen. I can see, getting a risk-free return there, or essentially risk-free return, almost no risk, over 5% is very likely, which is very, very attractive if you're someone like me and you're a hyper-conservative investor. When it comes to I-bonds, there is some good news. We are no longer on track to get 0% for May of 2023. With our 4 months of data, currently we're looking at the I-bond rate in May of 2023 to be about 2.4%, give or take a few hundredths of a percent. If inflation does what it did this month, or increases at all, that number is likely to go up. If there are some huge drops in inflation, again, not very likely to happen. We could see it again drop closer to 0%, but I don't see that happening. So if you're like me and you're thinking, maybe if I-bonds are paying 0% in May, I'll just wait an extra 3 months and surrender that 3 months of interest at $0 to get my full years back. Maybe I'm not looking to do that anymore, because if I can just leave my I-bonds in there, have the interest be tax deferred, and it's at something like 3 or 4%, I might just leave it in there. I'm not sure if I would be buying new I-bonds, given that the rate's probably going to be quite a bit lower or right at the same as a savings rate or a money market fund rate or a treasury rate, just because even if it's slightly higher, having that liquidity is going to be a lot more useful. And that about wraps it up for the January CPI report. If you have any questions or if there's anything I didn't cover, please let me know in the comments or in the Discord. I will be happy to go over them. If you have any questions about things I said, how I came to them, stuff like that, also please ask. I will do my best to explain them. As always, thanks for watching, and I will see you all next time.